Welcome to the INREM podcast, where we discuss the law for real estate investors. Andy and Sean are both attorneys. Nothing said in this discussion should be considered legal advice. We're simply providing information and education. You should consult with an attorney in your state regarding any specific legal issue that you may have. Hey, everybody, welcome to the show. Today, our topic is strategies for landing hard money loans and dealing with the lender. I'm Andy Fowler, and I'm here with Sean St. Clair. If you're new to the show, give us a like. Make sure to subscribe to the channel. You can find us on Facebook. You can find us on YouTube. On YouTube, we are at INREM Podcast. That's at INREM Podcast. Make sure to subscribe. That would help us out, and it would be awesome. With that, we're going to go to Sean, who's going to give us our legal update.
Yeah, thanks, Andy. So our legal update today is what is a deed of lieu? I can't speak today. What is a deed in lieu of foreclosure, and when is it used? Actually, a pretty good topic considering we're talking about lending today, and that's really the basis or the reason that you would execute a deed in lieu of foreclosure is when a property is subject to a lien of some sort, a mortgage, a deed of trust, and the borrower and the lender agree that it doesn't make any sense for the parties to go through the foreclosure process. So instead of completing the foreclosure, the borrower will execute a deed. But instead of it being a warranty deed or a quitclaim deed, it's a deed in lieu of foreclosure. And it basically says, hey, I recognize that I'm in default, that I can't continue to keep this property. And so I'm providing that to you, lender. Some people refer to, or real estate investors refer to a deed in lieu of foreclosure as a performance deed. And it does have that name because it can be used, when you don't perform to, provide or guarantee for performance. And in that case, it would be executed before a foreclosure occurs and basically put in trust or in escrow so that if there is a lack of performance, instead of the lender having to wait 90 days to complete the foreclosure process, they can pull out the deed in lieu of foreclosure and record that and take title to the property. However, it should not be used, and I've seen it used in this context, and it's wrong. It should not be used if property is being purchased subject to, but the seller is not being given a note and deed of trust in exchange for the transaction. Or in a situation where you're doing some form of joint venture agreement where there is no mortgage or deed of trust out there that you're giving the deed in lieu of foreclosing on that instrument. If you do that, then title is going to be all messed up because of the fact that when a title company looks at the deed in lieu of foreclosure, what they'll see is, oh, there was this mortgage or there was this deed of trust that was recorded. There was a default. And so the borrower gave the lender a deed in lieu of foreclosing on those instruments. But if those instruments don't exist as of record or as of or on title, well, a title examiner is going to look and say, what are they giving a deed in lieu of foreclosing on? It makes no sense. And so in that case, a deed in lieu of foreclosure is not something that should ever be used because, what are you, essentially foreclosing on? Or what are you giving the deed in lieu of foreclosing on, if you will? So that's something to keep in mind. The other thing to keep in mind when going forward with a deed in lieu of foreclosure is you have to be very careful that when you do take that deed as a lender, when you do take that deed in lieu of foreclosure, you're taking it subject to any liens, claims, or encumbrances, or even ownership interests that occurred after the date of the mortgage or deed of trust being recorded. So normally through the foreclosure process, you go through and you give notice, and there's certain, rights and remedies that senior not senior, junior interest holders, junior lien holders have with respect to the property. So you have to give them notice and go through that process. And then eventually, when you complete the sale of the property, it wipes them out. They don't have an interest anymore because you've gone through the statutory process to foreclose. But if you basically, as the lender, accept a deed in lieu of foreclosure, you're taking that property subject to any of those inferior interests. So you have to be very careful to make sure that you do a title examination, you review the title, and you make sure that, hey, this is going to have the effect of basically putting me in the position I would have been in had I basically gone through the foreclosure process. So that's a deed in lieu of foreclosure. It's something that can be used in an investor's arsenal, both as the borrower and the lender potentially. However, it has to be used properly. You have to make sure that there's a recorded mortgage or deed of trust that relates to that deed in lieu of foreclosure. And you have to make sure that if you are the one accepting the deed in lieu of foreclosure, that title is clean and clear, and you're not going to take it subject to something that you could wipe out through the foreclosure.
Yeah, I think that's incredibly important. And that's where I've seen most of the mistakes happen as a trustee in a trustee sale process. I've had lenders, usually not sophisticated lenders, but I've seen lenders, maybe individuals holding a lien who want to foreclose their interest. And they're like, well, that's going to take 90 days and that's going to cost this much. And it's going to require this kind of title report. Why can't we do a deed instead of foreclosure, in lieu of foreclosure? Why not? And I have to explain, look, that sounds great. And it is fast. It could be cheap. But you have to understand that the foreclosure process is like a sanitizing, like a bleaching process to something. It's cleaning the title. And if you don't go through that, you risk receiving a filthy, stinking, dirty title, right? Unless you do some serious due diligence. So something really to watch out for. All right, with that, a little bit of NREM news coming up this next Tuesday. NREM, we're going to be again live on-site live streaming from the Buy and Hold meetup. Again, that's November 29th, this Tuesday. It's formally starts at 4:00 p.m. That's kind of when the networking begins, your opportunity to come and meet folks, lawyers, investors, individuals in lending, whatever the case may be, your opportunity to market. Sean, why don't you kind of explain for our listeners who can come and who this is really ripe for?
Yeah. So basically, anybody can come, honestly. You don't even have to be in real estate to come. It's a free event. They have food and drinks and networking, like you said, good presentations. However, generally, the people that would want to attend the event are anyone involved in real estate, whether that be a real estate investor, a real estate professional, for example, realtors who want to become involved in the investment community, attorneys. We are there. We live stream the event. And so we're there. There's other attorneys that are there as well. There's title representatives that are there. There's lenders. In fact, our guest today, Andrew Bang, he's regularly attends the event and is one of the sponsors of the event. So there's, lenders that are there that attend. And basically just, hey, if you want to be involved in the real estate investment space, whether you're an investor or on the periphery, helping or assisting investors, lending to them, helping them with their transactions, this is a great event for you and you should come out.
Even if you're what my kids would call a noob to the real estate investor space, come to it. It doesn't matter. This is the place to start meeting the folks and mentors who are going to be a part of it. The topic is going to be construction and remodeling experts panel. There'll be some speakers discussing in a panel form, construction and remodeling. And Sean, why don't you explain for everybody what we as NREM will be doing as part of the live stream?
So we'll be out there on site before the actual presentations during the networking portion, and we'll interview the speakers. So they're having a panel there of investors who are experienced with remodeling and construction. and they're going to be sharing and giving some insights on what they do and how they do it. So we'll have an opportunity to interview them. We'll interview some of the other guests, some of the sponsors. We'll if anybody has some, legal questions or topics, we're happy to see what we can do to provide you with some information and education on those. But basically, we're just going to live stream, and then we will work with the host to basically live stream the actual panel and the presentation, so that can be watched live for those that are not able to head out to the event.
Yeah. So if you're thinking about coming, make sure to be there November 29th at 4:00 p.m. at the Scottsdale Area Association of Realtors. Look forward to seeing you there. With that, we're going to get into our topic today. Today, we're talking about hard money lending. The title of our show today is Money Doesn't Come Easy, Strategies for Landing Hard Money Loans and Dealing with the Lender. And today we have as a returning guest, Andrew Bang. Andrew, how are you?
I'm doing great. Thank you so much for having me again.
Yeah, thanks so much for being with us. I know this is, you've been with us before, but why don't you kind of give our listeners a little bit of your background, what you do, and your resume.
Yeah, for sure. So currently I'm a loan officer for Boomerang Capital. We're a local real estate investment trust right here in the Valley. It's basically a big fund of investor money, and we lend that money out to investors who are fix and flipping or fix and hold. And so my background, I started off flipping homes in 2008. Before that, I was an accountant. I went to Arizona State University. I was an accountant for about 6 years before getting into real estate. And so I flipped homes for about 10 years before getting involved on the private money lending side. And I've been with Boomerang Capital for about 4 years now.
Awesome. So let's get right into it, and let's just start with the basics here. Let's just imagine most of our listeners are noobs, and they're coming to this and trying to figure out how to get their feet wet and dirty. What is a hard money loan?
Yeah, so a hard money loan is a specific loan that's used to buy investment properties. So a traditional loan will look at your credit, look at your collateral, your assets. A hard money loan looks at the property. It is a asset-based loan. So I do not pull credit. I don't do full financial reporting on borrowers. I'm looking at the property. If the property makes sense, then I lend on it.
Are there certain types of investments which traditional financing is not an option or prohibited, but tend to fall within kind of the purview of hard money loans, or make sense more with a hard money loan?
Yes and no. So I'd say hard money is best for fix and flips, buying a home that's distressed. Normally, so I would say hard money loan is the equivalent of a cash offer. It's as close to a cash offer as you can get and still be a loan. The question I get asked by a lot of new investors or real estate agents is, oh, you don't pull credit. You're just looking at the property. I've got a great borrower for you, a great buyer. His credit's not great right now, or his employment's not great, so he can't qualify for a normal loan. And I say, well, hard money's what I normally say is hard money is not for bad borrowers buying good homes. It's for good borrowers buying bad properties. So it's for properties that are distressed, that are bought under market value, that have room in them, that would normally only accept a cash offer. Those are the properties I can lend on. It's the tool that you can use to buy properties quickly without having a lot of cash of your own cash in the deal.
Andrew, what type of regulations, if any, govern hard money loans? I know, conventional financing is heavily regulated, right?
Mhm.
You have all these different things that you have to do and disclosures and things like that to make a, conventional Fannie Mae, Freddie Mac backed loan, FHA loan. What about hard money? What kind of regulations do you guys run into and have to comply with?
Yeah, so I'm a licensed mortgage loan originator. Boomerang Capital is a mortgage banker. We're a licensed commercial bank. So there are a lot of regulations that we have to follow. I have to do my continuing education every year. There's certain forms that we need to ask for, but because we only lend for investment purposes. We do not lend to any owner occupied or homesteads. There are a lot of documents and forms that we do not have to ask a borrower for. But we are still regulated. We can be audited by the NMLS, and we observe all the regulations that we need to.
if I were to look at loan terms
Mhm.
and you just put down a couple of sheets, the conventional and the hard money,
Mhm.
and I'm looking at them side by side, how would I spot the hard money loan? What are the characteristics of a hard money loan that makes it different than just your, traditional conventional financing?
Yeah. So hard money is short term, high interest rate, interest only loans. So right now we're about 10 to 12% is what you're going to be looking at for a hard money loan. But we're a 6-month loan. I mean, sometimes we'll go to 12 months, but our average loan time is 4.5 months. So people are in and out of it quickly. So when I talk to investors about hard money loans, especially if they haven't used one before, I said, don't look at the 11% interest rate. What you want to look at it is, how much is this going to cost me to use your money instead of using my own money? And you say, all right, if I flip a home in 4 months and my hard money cost total on that is $10,000, well, that enabled me to buy that home with very low of my own cash into the deal. Where, yeah, the interest rate was 11% and there are some other fees involved. But overall, it made sense because I was able to buy that home or buy multiple homes. I was able to scale and use and leverage my own capital.
What is the difference in the underwriting process? How different does that look for hard money loans versus what we're all used to seeing with traditional?
Yeah. And so from my own, it's interesting because my background is not banking, it's not mortgages, which a lot of hard money lenders come from. My background is flipping homes. So when I first started with Boomerang Capital, just a little story here. My first loan that I did, there's a loan approval that we have to fill out with Boomerang that I have to fill out that I submit to underwriting, and my boss, David Nielsen, he underwrites the loans. So it was a home in San Antonio. The borrower was buying it for way under market value. It was a great deal. And so I wrote up just a small paragraph about the house, what he was buying it for, what he was going to put into it, and how much he was going to be able to sell it for. And I submitted it, and David shot it right back to me and he said, "You didn't write anything about the borrower." And I said, "Well, the borrower doesn't matter. Did you see what he's buying that house for? It's a home run." And I've changed since then. I do a little more underwriting. So I do write a little bit about the borrower and their experience, but the main focus of the loan is the property. What are they buying it for? How much are they putting into it? And what will they sell it for? If it's a good property, there's very few reasons why we wouldn't lend to someone on that property.
So, and I'm sure you track the market and nobody has a crystal ball. Nobody knows what's happening. But I will say that I think personally that the market has shifted some.
Yeah.
And so obviously underwriting standards are going to change with the market. How have your underwriting criteria, how's that changed maybe from today versus a year ago?
Yeah. So a year ago, we were looking at sold comps. What did a home sell for in this neighborhood? What could they get for it? We were adding in a little appreciation. Where today, I'm not looking at sold comps. I'm still looking at sold comps, but what matters more is what will be my competition. What is currently on that market in that neighborhood that is not selling? What is pending? When they put that on the market, if I'm looking at the comps only right now in this market, then I'm going to underwrite a bad deal because I can find comps, say, take a house in Queen Creek in a certain neighborhood. I'll have comps between 420 and 470, but then I'll have 3 homes on the market at 400,000 that aren't selling. So if I were to just underwrite that loan based on the sold comps, I'm undervaluing it because if they put that home on the market at 420, there's 3 other homes that are better choices for a buyer in that neighborhood. So it has changed a lot. So on the lending side, we're being a lot more conservative. The last thing a hard money lender wants is to take back a property. We want to send out our money, have it make friends, and come back to us. The last thing we want is to do a bad loan. So the borrower, we have to foreclose or do a deed in lieu of foreclosure. And because even if a property has a lot of equity in it, we don't want it because it takes up a lot of our time that we don't want to. We would rather be out there getting new loans than trying to handle a foreclosed property and manage contractors and find a real estate agent to list it.
So you've said that you've become a little bit more conservative now with the market, but are you still making loans?
Yes. So we're still making loans, a lot less than we used to, just because we are being more conservative. And when I say that, we're asking for more down payment than we used to. Most of our loans, say a year ago or even at the beginning of the year, we were going up to 90% of loan to cost and up to 75% loan to value. And right now we'll go up to 85% loan to cost, 70% loan to value, with some exceptions for return borrowers. We might go a little higher, but we want to make sure there's enough equity in there. So if the market does drop, then we are covered as a lender, and our investors are covered who have invested in Boomerang Capital.
So you mentioned as part of the underwriting process, there's a heavy emphasis on the property itself.
Yeah.
Which makes a lot of sense. You care. You're not engaging in a 30-year fixed rate, where you care about receiving payments forever. This is quick in and out, and you want to make sure the property's good. Investor financials have to matter somewhat. How much should the investor expect that to be part of the underwriting process?
We have an application that they fill out. It's not as long as a traditional 1003 application. It's one page. I ask for just basic assets. But honestly, we rarely verify. We're just trying to get a sense of who this investor is, what their experience is. The most important part of my underwriting process is talking to that investor one-on-one. Because like I said before, my background's not banking. I'm not, it's flipping homes. I'm asking them specific questions about their process. Who is the contractor that's going to be on this project? Has this contractor remodeled flip homes before? If this is your first home, where did that desire come from to want to flip a home? How much education have you gotten? How involved are you in the real estate investment community? Are you going to events? Is there going to be someone? Is your real estate agent have experience listing flip homes? Who is walking you through this process? I'm asking them one question that about the value of the property. If they send me a property and I have some concerns about the value, and I also have some concerns about the borrower, I'll say, hey, send me a CMA. And they go, well, what's a CMA? Well, there's one red flag for me saying, okay, they're not familiar with the process of comping a home, which is okay. Everyone's got to start somewhere. I love working with first-time investors, but I need to know who I'm getting involved with. So if they send me comps from Zillow, oh, I like this property because I saw these 3 sold comps on Zillow. Well, then that means they don't have MLS access. There's another red flag. That's how I look at how risky this loan is going to be. Those are the factors that I've determined that play a bigger part, whether the loan will default or not, than what their financials look like or what their credit score is. I've never pulled any investor's credit score, and I never will. I don't see that having any relation whether a hard money loan defaults or not. Where we see defaults is when the contractor, they're not managing the contractor, or the contractor is taking a lot longer, demands upfront money, is not familiar with how to remodel a flip home. Where I see issues with is partnerships. If there's a lot of people involved in the partnerships that don't have experience flipping homes, and there's contention among each of the partners. So those are the things I'm looking for when I'm underwriting the loan, not really the investor's assets or financials.
So some of it really goes into structuring the deal. I recall this from our last episode with you, which was one of the indicators of a deal that could potentially go south are the bad partnership couplings, or the one with all the money just sitting passively in the background while the one with no money in the deal is running the show, and kind of sets it up for a problem. Now, you mentioned hard money loans by design are designed to be shorter in term, not a longer duration. Is that to some extent negotiable between the borrower and you guys in terms of what the project's going to look like? I imagine not every project can be flipped in 4 months or whatever else. Is there a back and forth on that to determine really what the length is going to be on the term?
A little bit. So each hard money lender is different, and some they like the sliding scale terms where they can offer better terms, or I don't like that kind of bait and switch type of sales pitch. So my how I operate is every single one of my lenders, every single one of my borrowers gets the exact same loan. And it's my absolute best terms right from the start. Whether it's your first time investor or experience, first loan or 100th loan, I'm giving you my best terms from the start. I'm charging you the least amount that I can do the loan for. And I'm consistent that way. So whenever someone calls me, they know exactly what they're getting. I'm not making promises of a better loan in the future, or I'm not telling them if you were to buy a different home or I could do better terms. Nope, it's the same terms for every property. And we're talking about a single family flip. Now, once you get into multifamily buy and hold, then yeah, what would change is the down payment. So maybe I can't go 85% on a 10 unit apartment complex that they're going to hold on to for 12 months. We might structure that a little differently. But for a single family home, which is really about 95% of the loans I do, it's the exact same terms.
So that way an investor can know, I've got this project, Andrew's got this loan.
Mhm.
This is going to fit right within it. The only variable that might have changed since the last time I picked up the phone and called Andrew is the loan to value.
Correct.
Because maybe the market shifted a little bit, but I can basically rely that here's going to be basically the terms, interest, all that kind of stuff. And
Yeah.
if it fits my project, call. If it doesn't, maybe they need to look at a different type.
Exactly. And the other part of that is what I tell investors is you can call me, you can text me when you're on the way to look at a property. You don't have to have that property under contract. If you have a question about if I'm going to lend on it or not, just shoot me a text with the address and the price. That's all I need. 10 minutes later, I can give you a full term sheet, a pre-approval, and the confidence to know that I can close that deal in 1 or 2 days or whatever date you need it to close by. I'm trying to take something off of the investor's plate. I'm trying to give them the confidence of, once we've done a loan together and you've seen how my process is, and I try to make that process as simple as possible, I will back you on any future loan, any future project, as long as it's within these criteria that we walk through. Single family home flip, 70% loan to value. You're going to be good. I'm going to fund your deal. I'm going to be there when you need me to be there.
That really has to be kind of an undiscussed kind of advantage of the hard money loan, which is just the sheer efficiency of it.
Yeah.
The ability to, you would never be able to do that in traditional underwriting. And in an industry where the market's shifting and time is money, the ability to basically know on the fly. That's really what that is, to know on the fly whether this is going to fit and whether this is something they can pull the trigger on. Very interesting. So Sean mentioned before, we can't predict the market. The market is shifting. It has shifted since the beginning of this year to some extent. And you talked about some of the lending guidelines that have changed as a result of that. As a general rule, what have you seen demand do in this market decline? Has it increased for hard money loans? Has it decreased? What does that look like?
It's definitely decreased. So we saw it back in April. I saw prices, homes were starting to sit on the market a little bit longer in April. And we started to kind of be conservative right then, really at the beginning of May, end of April. But the demand was still there. I'd say through June, we were getting the same amount of loan requests as we had. And it wasn't till the end of June, July, when that started to slow down. But then August and September were great, bounced right back, had big months. And then October was almost crickets. So once that interest rate went up to 7%, it didn't hurt our hard money. The interest rates were exactly the same throughout
Sure.
the whole time. What it hurt was our investors in buyer. And so homes were sitting longer. The prices were going down. Even if they were able to buy the home for a better price and get a better deal, the home would not move as quickly. And so their holding costs would go up and their profit would go down. So a lot of investors froze. And I think a lot of investors are still just waiting right now.
So while a lot of investors would naturally turn to hard money as money becomes even tighter because maybe it's easier to get the money, the end buyer sale still relies on a traditional buyer who's going to use traditional financing. And so it just sounds like, and I'm sure you guys have theories on this, it just sounds like there's just a lot of money sitting on the sidelines waiting to see what happens. Is that what you think?
Yeah, no, we definitely have more capital that we'd love to get out there, but we're cautious to, and we're not getting the calls to come in. Yeah, so even if, and the other part of it is some of our investors like to hold on to them as rentals, but now they can't refinance for the lower interest rate, and so and then the rents, are not they're not able to cash flow as easily, so they're getting hit on two sides there because of the interest rates going up. Um, but yeah, we are definitely gearing up. We know that it's going to be slow till we're predicting February and March now that, if interest rates stabilize, the buyers will come back. But we're predicting here the rest of November is going to be slow and December is probably going to be slow. Where normally December is one of our biggest months for hard money, where real estate slows down in December, but that's when a lot of investors buy properties. So we do a lot of hard money loans in December, but we haven't seen that. And November is normally a big month for us, but it's been one of our slowest months this year.
So, Andrew, I want to talk to you about, you mentioned networking and the need for real estate investors to network, right? And in fact, you and I have connected at different networking events, the buy and hold, but there's been other, events that we've both attended together. Um, and you said that one of the questions you're going to ask these real estate investors would be, hey, what are you doing in the investment community?
Mhm.
Why is that important to you as a lender to know that your borrowers are out there, uh, connecting with other investors, educating themselves, gaining knowledge? What does that do for you? And what type of comfort does that provide?
Yeah, it's actually a really big part of if I would lend to someone or not. Did this person just watch a show on HGTV and get the desire to flip homes from watching that? And they honestly they'd have the wrong sense of how to flip a home and the wrong process. Or if they've gone to events, met with people who are actually doing it in their neighborhood, in their community, that have connections with other people that are flipping homes. So if something, so not only getting started on the right foot, getting the right contractor, getting the right real estate agent, the right title company, the insurance, the right attorney, everything that goes along with a real estate investment team. But if something goes wrong and someone on their team they have to let go, who do they have to fall back on? Are they just going to Google and typing in who can they go to say, hey, do you have a referral for me for a good real estate attorney or a good real estate CPA? Because this is going wrong right now in my flip or or with my title. I need to switch title companies. I need to switch. So if something goes wrong, who is going to be there to support them? If they just watch the show on HGTV, they're just trying to figure it out late into the process. And as a lender, now I have to get involved to help them out, which I want to do if they need the help, but I'd rather them already have that support there, knowing they have that support there before I even do the loan with them.
So with the changing market conditions, you talked a little bit about the reduction in demand of hard money loans, but there are particular as we discussed, real estate investment strategies that fit particularly well with hard money loans. The fix and flip. So you already talked about those, but those also are strategies that work typically in a strong market, right? So as you've seen demand in hard money declining, have you seen a shift in types of investments change that hard money also can help facilitate rather well, given what it does?
Yeah, I mean, we're doing a few more refinances. So just I'm trying to think. So last year I did 501 loans, and I think two of them are refinances. I fund on the purchase. That's what I tell people. But this year, there's a lot of people who have hard money loans with other lenders that wouldn't extend, or private money lenders who wanted to get out of the deal. So we've been doing some refinances with hard money. We've been doing bridge loans with people that just need to buy their next property and just need that money for 6 months or so. So there's other ways that hard money can help out, and we've been getting more requests for those ways than the traditional fix and flips. But fix and flips work in every market I've seen. When I started, it was during 2008 where there's thousands of foreclosures, it was really easy to buy a home, but it was much more difficult to sell it. Where the market that we've had recently, it's been really difficult to find a home, but once you found it, it was really easy to sell it.
Just flew off the market.
Yeah. And so either market needed hard money loans to buy those properties. But I think what we see now, it's just everyone's like frozen. No, there's no investors that want to buy a home right now. There's no in buyers that are buying right now. There's just a lot less, which is just everyone's just waiting to see what's going to happen in the future.
What can investors do to make themselves more attractive to a hard money lender?
Yeah, I'd say education. Education. And you know, the one thing that I really like in a borrower is the desire to flip a home. They really wanted to do it. They've thought about it a while. I'm not sure how they can gain that other than just having an entrepreneurial mindset, wanting to get out there on their own and build a business. Because really, a lot of these first-time investors, what they say is, I want freedom. I want financial freedom. I want freedom of my time to travel. And they see real estate as that path for them to get them there.
Will the hard money lender place a premium on a borrower who has a lot of experience in, let's say, a fix and flip type market? They've kind of got a track record.
Yes. Yeah. So yeah, no, absolutely. We all want to work with experienced borrowers who are easy to work with, know the process, and we can do multiple loans with them.
But that's not going to be like a barrier to entry for the new person in who's like, boy, I like what I heard. I'm going to try to change my trajectory in real estate investing. I'm going to get involved with some hard money lenders, make some contacts. The fact that they haven't had a ton of experience or they're just getting into it isn't going to.
Not for us. So there are some hard money lenders that will only work with someone who has a couple deals already under their belt. I love working with first-time investors. I love walking them through that process. That I did that same process myself back in the day, and everyone's got to start somewhere. And that's also a great way to build your network. Now, our target borrower is not a first-time borrower, and it's not an experienced borrower that's flipping homes full-time. The borrower that we've seen is the most productive and has the least amount of defaults is someone who has a full-time job and is flipping 4 to 6 homes a year on the side. That's the borrower we've seen have the most success for not only profits for their flips, but has the least amount of defaults. So that for whatever reason, that's our golden egg there.
Yeah, that's an interesting stat. What's your theory on why that is the case?
Multiple exit strategies. So if someone gets involved with flipping a home and for whatever reason, the rehab takes longer or they just can't sell it for the price they wanted to, they are able to refinance through a traditional lender and hold that as a rental long-term. And that is still a valuable asset, that property. Where if someone who is flipping, say 5 to 7 homes every month, a lot of times they're not using their own capital for those down payments. They're using private money, family money, friend money, and they don't have any money invested in those deals. And then when something with those flips go wrong, their only option is to take a loss because they can't qualify for that other loan as easily, or it takes a lot longer, or they'll get a really bad interest rate. So when something goes wrong with those full-time flippers, they tend to just walk away because they don't have any of their own money in their deal. They don't have any other options for exiting that property except taking the loss.
So I'm a real estate investor. I'm new to the market. You got me all excited. Where do I go to find the Andrew Bangs of the world? Where do I start making these connections with hard money lenders?
Yeah, so I'm a relationship lender. I go to as many events as I can that involve real estate investing. I teach. There's certain title companies that will sponsor me, and I'll teach classes for real estate investors and then realtors. And then, just to find me personally, I'm on Instagram and Andrew at boomerangcapital.com. But we do not advertise online. We've decided that the type of lending, the type of borrower that we want to lend to, we want to meet face to face. And so real estate events is a great place for that. Facebook groups is a great place for that. Go out there and network.
Yeah. So building your network or finding lenders is like building your network of potential real estate investors. It's really a process of getting your hands dirty, meeting people, knowing them, learning about them, and building those relationships, right?
Yeah. What's interesting is you'll go to a big real estate event, say it's one that they hold once a year, like an expo, and there'll be 10 to 15 hard money lenders at that event. And if a new real estate investor talks to each of them, they're going to come away thinking each one of these lenders is totally different. And that's why it's important to go out and talk to these lenders face to face and get a little bit of understanding of what a hard money is and how each one could be different. Loan to value, understand what loan to value and the difference between loan to value and loan to cost. What does a point mean? I flipped homes for 10 years and I did not understand what if a lender says, oh, I charge 1 point or 2 points. I had no idea what that meant. I just said, just give me the total cost on the loan. That's what I tell them. But 1 point is 1% of the total loan amount. So $100,000 loan, 1 point on a $100,000 loan is $1,000. 2 points is $2,000. So if you're flipping a home, say in 3 or 4 months, like an 8% loan with 3 points is a much more expensive loan than a 14% loan with no points. And investors don't understand that going in. They don't understand that the way that points and fees and interest rates work. That's why I say, just look at the total cost. If you flip this home in 4 months, what is your total cost of getting that loan through each of these different lenders?
What's amazing to me is, we're doing a show here that tries to provide educational content that adds value. But I think the perception generally among people is lawyers or these lenders or the CPAs or whoever they are behind closed locked doors, have assistants answering phones. And some of that is true, but the information you were just talking about and learning what it's going to cost, what a hard money loan is, that information is as close as going to the next marketing event and shaking that person's hand and sitting down for a drink. I mean, the information is there. The buy and hold meetup, for instance, the lenders are there. They're there to help you out because they want your business, right? It's just a matter of getting out there and meeting the folks. Let's talk about once the loan is made. Okay, they've gone through the process. Everything's good. Loan's been funded. How involved should the investor expect you as the hard money lender to be throughout the process?
Most of the time, I'm not involved at all. And investors want it that way. They want me to fund their deal, make it as easy as possible, and then once they have the property, I stay out of their way because it's their deal and they can choose their own rehab design and contractors and real estate agent. For some first time borrowers, I want to be involved with the deal because I'm able to add some value to what they're doing. I can refer those contractors. I can walk properties with them and give my opinion on design choices, what I think would sell, the quickest for the most amount of money. But I offer that if the investor wants it or not. But for the most part, once that loan's done, I'm out of the picture. I call and follow up every other week just to see how they're doing. A lot of times what I do is, and what I tell other people is I'm their cheerleader. If certain investors want me to go to the property once it's finished, and then I'll walk through the property, and I'm not there to give any critique or say anything negative about any design choices, no matter what they did. If that property is complete and they call me up, say, hey, we got this knocked out in a month, we're putting it on the market next week. I'm walking through it and I'm saying, this kitchen is amazing. I love these design choices you did in the bathroom with the custom tile. I'm their cheerleader. I'm saying you did a great job. It goes on the market and we'll see if it sells or not. But I'm there to support them with whatever support they want. But for the most part, it's very hands-off after the loan's funded.
It sounds like you assess some of that on the front end, meaning your default position is, hey, we're lenders. We want our payments. We want this to go great, but you go do what you do. But depending on the project or depending on the experience level, you'll build in on the front end what your involvement's going to be.
Yeah, for sure. We do rehab on almost every one of our loans too. We provide rehab funds, and that's a way for us, the lender, to get an update on the property almost weekly. If someone's taking a rehab draw every week, then I'm talking to that borrower, about what they did. They're sending me pictures. They're sending me invoices of the work. So we do, as a lender, like to get updates on that property. So if they are doing the rehab themselves, then I do call probably every 2 or 3 weeks to just check in to see how they're doing. But I rarely do a visit to a property unless there's a problem, unless something has gone wrong and they're having issues, unless the borrower specifically asked me to come out and take a look at the great job they've done.
Let's talk about problems. All right. Since you brought it up,
Yeah.
the lender always brings up the problems. I'm just kidding. So maybe payments aren't being made, or maybe you're in great communication and payments have been made, but everybody's seeing the writing on the wall and where this might be coming. How aggressive, once the loan has gone into default, are hard money lenders typically in pursuing their remedy of foreclosure?
Yeah, we want to get, if the hard money lender has to take back the property, something has gone horribly wrong, because we're only lending on properties at 70% of value, and they're putting down a down payment of at least 10 to 15%. So when the loan is first done, we're covered by at least 40% equity there, if not more. So if we're taking back the property, they've lost a lot of equity.
Yeah, they've got a lot of skin in the game going into it, right?
Yep. And so if we get involved, then we're trying to foreclose on that property as quickly as possible. If a deed in lieu of foreclosure is an option, then we take that. But like you guys were saying, most of the time there's a mechanics lien or a tax lien or something on there, or there's a second lien holder, and then we just go through the foreclosure process because we want that clean title and we want less liability after we take over that property. But if there's a chance, especially in a partnership where there's a chance of one of the partners going bankrupt or going down that filing for bankruptcy, we want to get that property back as quickly as possible, because once that happens, then it's a whole drawn out long process.
You want to try to get ahead of the bankruptcy.
Yes. So that's our biggest thing there is, I hope they didn't file yet, and we need to get that property back.
So you don't get stuck behind the filing and be in a position. As a secured lender, you'll get it back at some point, but it's not 90 days anymore, right?
Right. It's all about time and our time, the time that we get the property back and the time that we have to spend getting the property back.
Is there a process when the loan is in default to decide whether, hey, look, these guys we think are like a month away from moving this thing.
Yeah.
We think it's worth kind of pulling back and letting this thing play out for another 30 days. I guess that probably is project to project. Is that right?
Yeah. For the most part, we'll always extend the loan if they're making their payments. Yeah, right. So we never want to be in a situation where we're taking the property back if it's on the market and just not selling. Well, then we'll let them keep the property and keep trying to sell it, and we'll work out some deal if they can't make their payments, then we got to work something out. But if they are willing to stay with the property, and then we'll let them keep it. Yeah, we don't want to, because if we take the property back, we're in the exact same situation. We're just giving it probably to the same real estate agent or a different real estate agent and going on the same market. And so if we can have them do that, then we take that option.
So foreclosure is really, you get to that point when the borrower is at a place where they just have no ability to even revise the loan that they originally had to extend the term and continue making payment. They're just basically dead in the water, and no payments are forthcoming.
Yeah. I can't remember the last time that we've taken back a property that was fully remodeled. The rare cases that we have to default on a loan, the property is just stripped down to the studs. Money was misallocated. Contractors, maybe there's some fraud involved. Something has gone, or the partnership just blew up. And when we take that property, it's at the very beginning of the demolition stage, remodeling stage, and has a long ways to go.
Do the changing market conditions have any impact on this decision, or is it pretty standard for hard money lenders to basically have their process for determining when to foreclose or change the loan to drag it out, or does the trigger get shorter when the market weakens?
I'd say that the trigger gets longer when the market weakens. Yeah, we want to keep our relationship with our good borrowers. And sometimes the market changes and it's not the borrower's fault, but we have a good relationship with that borrower and we want future loans from that borrower. So we're going to do everything we can to help them get through this property. There's still going to be a loss that they'll have to take. And we might have to take a little bit on our end, but honestly, when the market's really great and investors are making, say, the average flip profit last year was about 26,000. When they're making really good money, we're not making any more. We're just making what our loan is. So in a down market, when investors ask us to take a loss, it's hard to, because we never took a gain when you guys were taking gain. Why should we take a loss when you're taking a loss? We're just the lender. We just have our monthly payments exactly the same. We'll do what we can with the loan to extend it as far as you want it and make some changes there, maybe put some fees on the back end once it sells, or maybe work out a payment plan or some way where we don't have to take back the property. You're still in control as long as there's, no chance of bankruptcy or other liens being filed on the property. And let's sell the property and take that loss. But we want to work with that borrower, because once the market gets better, we can do another loan with them. We don't want to ruin that relationship.
Yeah. Well, think about how different that is when you everybody remembers the last financial crisis, the Great Recession, and everybody remembers trying to modify their loans.
Yep.
And what that was like to call the traditional lender, get them on the phone to work with you to do that. It was painful, and some would say it was probably impossible. Whereas hard money lending on this kind of on these kind of projects, they've got text and phone call access to you right now to really. It's not a legal partnership, but in a sense, it feels kind of like partnering in on a deal, right? Everybody's got a stake, and everybody's willing to talk through it and get it worked out. Andrew, this has been really good information. We really appreciate it. So remind our listeners again where they can connect and find you.
Yeah. So boomerangcapital.com is our website. And my email is andrew@boomerangcapital.com. I'm also on Instagram and YouTube and TikTok now. So any of the social media platforms, I'm on there doing videos.
All right. Find Andrew on any of the social media platforms. Give him a call. Come to some marketing events. You'll find him. He'll give you even more information. Again, Andrew, thanks so much for being with us. We appreciate it.
Thanks for having me, guys.
All right. With that, everybody, that is our show today. Make sure to join us next Tuesday. We're talking about establishing business lines of credit with guest Steve Howard, CEO of Prime Corporate Services. Also next Tuesday evening, we're live streaming at the Buy and Hold Meetup. Make sure to be with us. We'll see you next week.
Have a good day, everyone.